The information in this podcast is not intended to be used as the primary basis of investment decisions. Any forward-looking statements are not guarantees of future performance, and actual results may differ, or other factors may change.
Welcome to Making Sense, the podcast for anyone interested in diving into the investing and startup space. Hosted by us, Emma and Carmen.
We are interns at Red Thread Ventures, an investment and advisory firm based in Vancouver. From interviews to startup advice, we will take you on our journey as we learn more about the finance industry.
With that being said, let's get right into today's episode.
Hi, everyone. Welcome back to our podcast. Today, we have Anders here with us to talk about a topic that we haven't covered before and one that we aren't too familiar with ourselves: gold, bonds, and inflation. So we are ready to jump right in and start absorbing. But before that, Anders is a senior financial consultant and principal at Golden Horde LLC and has great expertise in investing and consulting, especially in this space. So with that being said, Anders, why don't you tell us a little bit more about yourself?
Sure. Well, I got into finance and economics from an early age. I started reading The Economist when I was a teenager, and I still do. I've always been passionate and fascinated by it, and I've been fortunate enough that I've had a career that's allowed me to learn more and be more and gather more about it. I did an undergraduate in economics at Carleton, and then worked for a year with the Department of Finance, and then went off to do my MBA at Toronto. Following that, I went off and worked with Citibank and then with Bank of America on their capital markets and private banking groups. That's bankies. There's always special words in banking. That's really the trading desks that you see where you trade currencies and commodities. Different desks trade different things, of course, but I started working on a bond options desk. So I learned a lot about derivatives and bonds on that desk. I was doing sales, but I'd work very closely with the traders and often help them out sort of as an apprentice. Then moved on to doing currency and bond trade combos, and then moved onward from that to doing advising high net worth private clients with regards to how to use all these various products to manage their investment portfolios or their exposures. I was fortunate enough that that journey took me from Toronto to Frankfurt to London, then to San Francisco. I was in San Francisco in the late 90s and then ultimately joined a startup group, but it was 2001 when everything went pear-shaped. So I went back to banking after the year, and ultimately came up here to Seattle, where I've been for the last 25 years.
Awesome. So you touched on a little bit there how you got into investing in the first place. So we're just a little bit curious, what does your investment portfolio look like as of now? So like what industries and securities are staples for you?
Well, I got into the public markets because I was in the public markets. I sort of got thrown in deep into the pool as part of my job. As I mentioned, it was in derivatives. So I was fortunate enough to work with some people that obviously they were very smart, but they're actually really, really good at explaining the concepts and all of the plumbing behind bonds and derivatives and swaps and options and all the rest of that. So I started having a natural interest in that because, of course, it ties into economics and finance. And I'd say some of my earliest investing was some of the craziest investing because I had exposure to these particularly unusual products. Some of them worked out, some of them didn't. Now, over the years, my focus in my career has always been on cash flow and capital management. And so my investing reflects that. And it's important when you're looking at investing to have a clear idea about just how much time and energy you want to spend on it, whether you're doing that with the view of getting long-term growth, and to what extent you want to do it because you actually enjoy trying to see if you can make a bit of money doing something you're really interested in. The two are often very different. And that's okay. In my case, I focus a lot on investing in securities that are cash flow yielding. So they may be high dividend bonds or stocks, or more likely funds that are invested in high dividend bonds and stocks. So high yield bonds, dividend paying strategies, option writing strategies, both international and domestic. Then I do a lot of hedging and diversifying around them. And I think we'll dwell on that in a second, to manage the risk of that portfolio downward and into a more managed bucket as best as you can. Diversifying and hedging in the popular press is often both called, they're slung around. They are actually different things. when you hedge an investment, what you're doing is directly taking some of the risk out of the investment, some of the volatility out of the investment. So if you buy GM, one of the car stocks, and you sell Ford on the other side in exactly the same dollar amount, you've hedged some of your original GM investment, because what you've done is taken away general market movement and even general car stock trends out of your investment, and you focused really just on the GM is better than Ford piece. To contrast that with diversification, you're making multiple bets. So that would be you buy that GM stock and then you go and buy, to get into today's topic, some gold as well. Your portfolio now has different economic drivers, but you didn't specifically reduce the risk of either investment. So hedging, you're cutting out some of the risk, some of the exposure of an investment. Diversifying, you're taking on different exposures. I do both in the portfolio that I manage for myself and friends and family.
Mm-hmm. Yeah, that's a really great overview. You did touch on one of the big topics for today, gold. So I think we're going to just jump right into it right away. There's this popular quote from Warren Buffett. He said that gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Many high-profile investors like Warren Buffett do not particularly enjoy investing in gold. So we want to know what your sentiment is when it comes to this quote and all of these opinions like this as well.
Sure. Well, gold has always had a lot of attention, but it's picked up in attention now because it's contrasted to the cyber currencies, of course, which are often by many commentators are touting them as an alternative store of value like gold. We can get into that in a bit. Gold doesn't generate any value in and of itself. When you own a bar of gold, it doesn't have little baby bars of gold that you raise and then you can sell on to make cash. That's very different, for example, from investing in a bond where they pay you an interest coupon every month or every quarter or every year, or a stock where they grow the value by running the business properly and either pay you back with dividends or pay you back by increasing the value of your investment. That's why Warren Buffett and many mega wealthy don't have a lot of time for gold. But there's a reason they don't need time for gold. If you've got enough money, then it doesn't matter how much your portfolio goes up and down. Warren Buffett, I'm sure he'd be upset if his portfolio dropped by 50%, but it wouldn't impact his lifestyle, especially his lifestyle. And in the case of many of the high wealth, it won't impact their lifestyle at all. Gold serves in investment portfolios as only a diversifier. That is, its virtue is that for millennia, it has moved different in its valuation to equities and bonds. And because it moves differently in its valuation to equities and bonds, when you mix in some gold into an investment portfolio that has equities and bonds, it damps down the amount of fluctuating in that portfolio, especially if you do what's called portfolio rebalancing. Portfolio rebalancing is the concept that on a regular frequency, you reset the weights of the various components of your diversified portfolio back to where they were before. To be very simple about it, if you started with a portfolio that was 90% stock and 10% gold, and over the next month, gold doubled in price and stocks didn't move, at the end of the month, you'd have a portfolio that was 80% stocks and 20% gold. In rebalancing, you'd get them back to a 90-10 by selling your gold position down and adding that value over to the stock position. In doing that, you essentially cut out a lot of the swings in each asset class. When the asset class is lower than the others in its growth rate, you add a little money. When it's higher, you take a little bit out. It's been proven over and over again to be very effective in both boosting long-term returns, but also especially in managing the swing of the total value of the portfolio. So gold's primary role in any investment portfolio is diversification. There's also a bit of an emotional component in there, which is why it's such a widely traded asset. It's pretty. You can make nice jewelry out of it. It's soft, it's quite dense and easy to carry and always has been. So it has served as sort of an ultimate store of value. But to Warren Buffett's point, it only serves as a store of value because we all run around saying it serves as a store of value. You can't actually generate cash from gold if nobody wants to buy it from you. And that all comes down to some of the questions that people have about cyber currencies as well. But with regards to gold, the benefit of it in a diversification in a portfolio is it does have lower correlations to equity movements and bond movements. It is tradable very smoothly. That is, you can get a good price all day, every day. It's tradable in very small increments, which is also important. So an Emma or a Carmen starting out with a $5,000 or a $10,000 portfolio can have a little bit of gold because you can buy it in a small enough chunk, right? Whereas now I know you can buy fractional Bitcoin. It's hard, for example, to buy a single share of Warren Buffett's company because it's $5,000. And so next thing you know, half your portfolio is one stock because you can't get a fraction. I know market innovation has improved on all of that, but that's fairly recent. So I think there's still a role for gold in portfolios, specifically as a diversifying asset.
Yeah, that's definitely a great perspective. And just speaking to your point about Warren Buffett, it really emphasizes the point of kind of investing to cater towards your own lifestyle or what you're trying to get out of investing. But there are many innovative industries with a lot of hype right now, particularly like crypto and NFTs. So there has kind of been little innovation within gold and its industry. So how do you think gold can continue to compete as an investment option?
Well, there's only so much innovation you need. When I look at gold, and I've looked at cryptos, I've looked at other stuff, because what I'm looking for simply is, as I mentioned earlier, a very liquidly traded asset. So you want a security you can get into and out of very quickly. You want to be able to convert cash into it without a lot of cost or difficulty, and out of it without a lot of cost or difficulty. You want it traded liquidly. That is, you want a fairly smoothly running price. It'll go up and down, but you don't want to have to wait 3 days to find out what that price is. And you want a low correlation, and you want it cheap. You don't want to have to pay a lot simply to run it. And we'll get to why that sometimes impacts gold's, why inflation can impact gold. It has to do with the cost of trading the asset or holding the asset. And then you want something with a low correlation. The jury's kind of out on whether cryptocurrencies have low correlations or not. In some regards, they seem to, in some regards, they don't, since they really only have come to the fore for the vast spectrum of investment portfolios in the last couple of years. It's hard to say. And that's certainly something I'm watching. How much innovation do you need in gold? I mean, you can trade it in teeny weeny chunks. You can trade it in futures. You can trade gold miners as a leverage play with a bit of a corporate backed value buildup on gold. You can hedge it. It isn't already trading as much as it needs to. Why does gold continue as an investment option? Because it's been around for literally tens of thousands of years, since the dawn of time, human time. Gold has been, in fact, it was probably one of the first monies and one of the first considered stores of value. So gold's virtue is its inertia. I think there's absolutely a scenario in the future where that store of value power of gold diminishes, and it may already be happening in part to alternatives like cryptos, or in part to alternatives like silver and other commodities. But I think that will happen slowly. So for now, gold is still typically around 1 to 1.5% of total global investment assets, including illiquid assets like real estate, bonds, equities. When you add them all together, what we see is a fairly persistent global allocation to gold, around the 1 to 1.5% rate.
Mm-hmm. Just want to follow up to clarify, do you think that cryptocurrencies is going to be diminishing the value of gold then?
I think it has definitely sapped some of the steam out of gold already. I mean, there's a lot of people who talk about cryptocurrencies as a store of value. I don't think they meet what I would consider the qualifications to be reliable stores of value. The biggest two issues with cryptocurrencies is the liquidity, which is an issue that's getting solved quickly with regards to going in and out of crypto versus regular cash. For example, I saw MasterCard just wrote a deal with a large entity, and PayPal has now allows you to buy and sell in crypto. So that liquidity item, the issue about hopping in and out of getting in and out easily and cheaply from cash to gold to cash to crypto to cash, that I think that gets solved and gets solved soon. Store of value, though, by definition, when you want a store of value, you'd like it to move around a little bit, preferably in your favor. You really have an issue with it if it moves too much. And that kind of comes back to hyperinflation problems, right? The challenge with the cryptocurrencies right now is that they are so extremely volatile in value day to day. And that makes it impossible to set some aside and assume what value they're going to have on any given day going forward. That's not yet quite the case with gold.
Mm-hmm. Yeah. So in comparison, do you think that gold is still a good investment, or would it be more smart to put more money into cryptocurrencies since they're upcoming and growing?
I think if you're comfortable, if you're fascinated by crypto, we come back to a point I said earlier. You can invest for many different reasons. Sometimes people get their passion and curiosity in a particular investment confused with their long-term retirement plan. And you don't need to combine the two. It's perfectly okay to peel off a part of your investment portfolio and go and fiddle around in something you're curious or interested in, recognizing that you may or may not make money at it, or that you may burn your fingers a few times before you really figure out how to make that something that generates value for you in the long run. I think crypto probably fits in that bucket right now. Definitely, there's a lot of institutional and private investors who are looking at adding crypto to their portfolio, specifically for similar purposes as gold, as a potential diversifying investment asset and something that makes sense to get involved in because it may or may not grow in value. It's hard to say any given crypto will grow in value, even though one cryptocurrency like Bitcoin or Ethereum may have supply limits on it. The reality is there's over 9,000 cryptocurrencies. So there's no limit to the amount of cryptocurrencies that can be created. Ultimately, we're going to have a little bit of a challenge here figuring out how do you manage supply for the space as a whole versus for a single currency, when after a while, maybe flow just goes to newer and newer crypto. So it's still a whole space that's evolving. I think the underpinning blockchain is a phenomenal technology and one that we're going to see applied in many, many areas over the decades to come for improved efficiency. But as for getting involved in crypto, I can only say for myself, I've looked at it. I don't think I'm quite ready to take out some of my gold for that. I'm actually looking at maybe silver or copper as alternative diversification assets to mix into the gold portfolio.
Awesome. So earlier we were talking a little bit about hedging and hedging in general. So gold is often hailed as a hedge against inflation. So why do you think this is the case?
Well, I don't. But gold in multiple studies has been proven to have not a great hedging capacity against inflation. It has an inverse relationship to inflation in that gold does seem to have a strong relationship inversely to real interest rates. So the real rate of interest is the nominal interest rate, the interest rate you actually pay, minus inflation. Because if you're paying interest, but inflation is reducing the cost of that, you come to what your real cost of carry is. Recall, gold doesn't generate any cash. There's no little baby golds being born. So when you buy gold, you actually, if you borrow money to buy gold, you're paying for the privilege of having gold. That payment rate is the real rate of interest. If that real rate goes lower, gold is cheaper to hold, then people are inclined to hold more. So gold prices do have a long-term relationship inverse to the real rate of interest. How does that relate to inflation? Well, if the nominal rates of interest don't change and inflation goes up, real rates go down. So in the short run, if people decide that interest rates are not likely to change, but inflation is going up, you would expect gold to ultimately rally. If, however, interest rates do ultimately rise, for example, to combat excessive inflation, then your real rates will come back up again and gold will go down. So it's an indirect relationship as an inflation hedge, and in aggregate is probably not the best you could use.
Mm-hmm. So are there any other securities or investment options that you think are much better then?
Well, you can, in the US, they have Treasury inflation protected securities, literally called TIPS. And they are a direct hedge against inflation in that the final payment you receive on them is increased by the amount of inflation each year. So that would be a direct hedge. They're looking at having tradable CPI futures, so you could enter a position that is directly inverse to inflation. You could look at oil. In fact, you almost be better off related into oil stocks because often oil goes up and down a little bit with inflation. Silver, many industrial commodities like copper and silver to a lesser extent have a little bit more inflationary power because as an economy grows, inflation tends to pick up, but so does the pricing of these short supply industrial metals like copper. In general, you kind of put a bundle together. There are securities you can also invest in that will tend to benefit in an inflationary environment. So you might not call them hedges, but great diversifiers. Ideally, what you want is a security where the company has the ability to increase their prices partially or wholly at the rate of inflation, but their costs do not. Ones that spring to mind very quickly are the ones that have large fixed costs. Real estate. You don't have to buy more apartment building because the inflation rate went up, but you can charge more for rent. In a similar vein, any large fixed capital cost, pipeline companies, large refiners, utility companies, many of the renewable energy companies have, if inflation raises the price of electricity, their revenues will go up, but they've already paid for the solar farm or the wind farm. So those are excellent ones to look at. And even some of the SaaS companies have already kind of invested, if you will, in their fixed cost base, and they don't have a lot of incremental cost to add a new user, but they'll get some revenue pricing. You could think of anybody that does large scale distribution, even a Netflix. If Netflix can raise their revenue rate at the rate of inflation, how much did that really cost them to actually, how much more server power or staff power did they have to add? Probably a very small fraction of it. So you want to look at securities and see how much pricing power do they have or margin growth power do they have in an inflationary environment on the revenue side versus the cost side.
Yeah, at the beginning of the episode, you talked a little bit about bonds as well and how bonds might adapt to inflation rates. Can they be affected by the real rate in a similar way to gold?
Yes, unfortunately, the other way. So with bonds, recall that very basically, when you buy a bond, as soon as you buy a bond, you have essentially locked in a stream of fixed cash flows. That is, whatever the bond pays in coupons and then the repayment at the end. So as inflation goes up, the value of those diminishes because they're fixed as a specific value. Secondly, the other reason it diminishes, looking at a different perspective, is now companies will start issuing bonds at higher rates, which will be a better alternative than the one that you own. So what we see is that as inflation rates go up, bond prices go down. That is because their yields go up, and yield and price are inverted in a bond. But essentially, inflation saps the value of that fixed cash flow stream that you bought as a bond, and therefore makes it worth less today than it was when you bought it. So bonds, unfortunately, are inversely correlated with inflation, and you'll often see the bond market reacting to inflationary news or inflationary pressure news. And we've seen a lot of that certainly this year as we come out of the pandemic and everyone's trying to assess the difference in growth opportunities for companies and for the economy as a whole versus inflationary pressure. So you've seen bond rates bounce around a lot based on that.
For sure. So just kind of transitioning this conversation, you already kind of mentioned our kind of post-pandemic world that we now live in, and you also talked a little bit about inflation, how it can affect bond prices, but can you talk a little bit more about some of the causes of inflation, especially in the post-pandemic world?
Yeah, so inflation, it's easy to get confused sometimes between single price and inflation, increases in prices, and national level inflation. So for example, if we look at something like lumber, where there's been a lot of headlines about lumber prices went up very aggressively earlier this year, in part because a whole bunch of people who were stuck at home decided they wanted to build new decks, and in part because there were a lot of supply disruptions to the entire chain. Some sawmills had shut down. So you had a supply crunch, you had logistics issues in getting the lumber out, and then you had this sudden burst of demand. Whenever demand and supply, whenever potential demand exceeds potential supply, prices go up for a given commodity. Do they stay there? Well, what we saw with lumber was as people started going back to work, they stopped building decks. A lot of supply chain issues got worked out and the sawmills started cutting more. And now lumber prices have come back down again. So what that represents for that one commodity of lumber is what's called a shock, a price shock, that is an increase in the price level, that then, because things worked out and it came back down again, basically worked its way out. That's not inflation. Inflation would be during the period that the price is going up. Inflation is persistent increases in prices, and that's what central banks worry about, and that's what you particularly worry about. So what you're hearing about right now is a lot of rhetoric and a lot of discussion from central bankers and market participants. They're seeing prices go up as we come out of the pandemic, with people wanting to buy more goods and services, wanting to consume more, finding that supply chain issues have arisen and supply issues have arisen, and prices are getting bid up. The US Fed and most central banks around the world at this point, and I'm with them, view these as likely to be transitory. That is, they think, look, we're coming out of an exceptional period of imbalance. We're going through another period of reversed imbalance, but it's all going to work its way out. I think what's important to recognize is that doesn't mean prices have to come back down again. They may just stay at the levels they were at, right? That's enough. So long as they don't keep growing at a high level, the inflation will be deemed to be adequate and under management. Only if inflation rates, they've now popped up quickly in the short term to 5% per annum equivalent. If you keep seeing that over multiple years, 5% on 5% on 5%, that would be considered an excessive rate of inflation and of significant concern, right? Then the question comes for bonds, for stocks, for gold, what's happening to interest rates on the other side? For bonds, it's bad. The bond prices of any existing bonds will go down. New bonds that get issued will be issued at higher yields to catch up. So for new bond investors, you'll be getting a higher interest rate on your money. Great, so long as inflation ultimately does come down, in which case bond prices would then pop. But in the short run, higher inflation means lower bond prices, which means the existing bond portfolio loses value. What about gold? Well, again, the question we come back to is what happened to the real rate? If in the short run inflation goes up, but the real rate, the nominal interest rates don't change, that means real rates went down, and gold may very well pick up some pricing and gain in value. If, however, interest rates come back up to meet inflation and real rates rise, then gold's going to lose some of the demand power that has otherwise. And for stocks and other securities, it's really that balance, almost stock by stock, as to how much impact are they, how much inflationary pricing power do they have versus cost base. And on top of that, now we have to roll in, for such a large sector of the economy, if interest rates go higher, how much does that impact the company's cost of borrowing funds? So what we can say is that if we get persistently higher inflation, it's going to be a lot of turmoil and volatility.
Mm-hmm. No one really likes seeing their stock prices go down, their investment value go down. Is there any way that we could minimize the risk of losing money when inflation is rising with our investment?
Well, you can go to cash. I
Yeah.
mean, but even cash, if you stuck the proverbial stack of dollar bills under your pillow, that will be losing value in inflation over time. You could go to short-term interest securities on the belief, if you believe that ultimately interest rates will catch up to inflation and get you out to about a zero real rate. Or, as mentioned before, you can at least move a portion, or as much as you like, of your investment portfolio into securities where you're quite comfortable they're going to have inflation protection power. As I mentioned, when I talk to clients, I recommend using some of their traditional fixed coupon bond portfolio, allocating that into stuff that still pays a steady, not even necessarily the same cash flow, but a fairly constant cash flow, like real estate income trusts, master limited pipeline partnerships, utilities, renewable infrastructure companies. These all have the characteristic of high fixed costs, so therefore very low marginal costs that are going to get impacted by inflation, but the ability to benefit from inflation on the revenue side.
Great. So, I mean, we've talked a lot about inflation and bond prices and whatnot, but can you kind of just clarify and just give an overall recap of what some of the ideal conditions are when you're looking to buy bonds for someone who knows nothing about bonds and they want to jump right in? When is the right time to do that?
Well, you should never be you shouldn't be trying to time the market, because there's about 1 billion people that are doing it, and many of them are armed with a lot more information than you are. So what's important when you're building a portfolio or deciding what your investments are, and we'll talk about it on a portfolio basis, is how do you want it to look over the long run, and then not try to guess when's the best. There's bad times to enter any market, but that's usually a day-by-day issue when they're extremely volatile, going up or going down. You don't know what's coming next, and you don't really want to get caught on the wrong side of a big lurch. It's rough if you lose 5% the day you put the money in. That's just miserable, even if it does get ironed out in the long run. Bonds still make sense in a portfolio because they also often have low correlations to equities. So they, like gold, help ballast out a portfolio as a whole. Unlike gold, of course, they do earn you a return, so they're worthy of a higher weighting than gold in your portfolio as you try to diversify it. The best conditions for buying bonds are ones in which you are coming out of you have high interest rates, so you're getting a lot for your bonds. You have had high inflation, but it's coming down very quickly. So in fact, the late 80s through to the late 90s, and in fact, we've had like a 3-decade-long fantastic bond market because we had enormously high late 70s, early inflation. Interest rates got raised really high to combat that, led by Paul Volcker down at the Fed back in the day. So people who invested in bonds back then were getting like 15% per year coupons, or 16, 17, 18. Mortgages were in the 20s. But those high interest rates did the job, and that monetary anti-inflationary bias has been in place now for 3 decades. And so inflation has steadily dropped, making those bonds more and more and more valuable because the interest rates have dropped, inflation has dropped. So those cash flows, every time you invested in cash flows, next year they were worth more than they were the year before. I think it's hard to say that that's going to be the case going forward over the next 10 to 20 years because interest rates are so low. But Japan has also proven that to be wrong. Japan has been at low to negative interest rates for a long time now, decades, and Europe's been there for many, many years too. We may be here for a while. That's part of the reason as well. The challenge now becomes with bonds, your interest rate is so low that you're receiving another reason to move some of it into something where you're at least getting a few percent out of your pipeline or your real estate investment company.
So what percentage would you say then should be allocated to both bonds and gold?
Well, I like to say the first thing about investing is that it should make you happier, right? I'm not saying it's going to make you 100% happy, but the last thing you want to do is invest in a way that somebody told you to do that then result in you becoming all stressed and miserable about your investment portfolio because you don't know why you're in there and you don't feel comfortable with it. They're supposed to be helping you save for longer term happinesses, whether that's putting money aside for 2 years to get a new car, or whether it's saving for your retirement so you can contemplate reducing the amount of time or how you work. So all of these things are subject to each person's comfort level and how much they particularly buy into a particular management style for their portfolio. The classic for gold, it's been about 10%. It's kind of a bog standard allocation. If you really feel comfortable, for example, because you, live in the world mining capital of Vancouver, and you know a lot of people in the gold mining business and you hear a lot about gold, maybe you'd move it up a little bit. If you don't know anything about it and you feel like it's old school, maybe you only put 5% in gold and maybe you even throw 2% into some cyber currencies because you're fiddling around with those on the side. Bonds, the classic portfolio up until very recently has been 60% equities, 40% bonds. Again, as I mentioned, I'd at least split that 40% bucket for bonds into what I could call fixed income assets or income assets. So take some of that 40, don't buy all government of Canada's with that. Maybe buy some high yield debt, maybe buy some emerging market debt, maybe buy some, as we said, some real asset securities like real estate, pipelines, and renewables. So you've mixed it up, but you've still got something that produces a regular cash flow and isn't an equity.
Oh, yeah. Also, another really interesting thing we talked previously about was some advice that you said you'd give to your younger self when you first got into investing. I thought it resonated a little bit with me. So do you have anything that you'd like to share with the rest of the viewers here?
Yeah, I wish I had invested in I got so wrapped up in either the funky little things that I was like derivatives and Brazilian government dollar denominated bonds that I encountered in my working life. And I did all right on that, and that's fine. And I got so wrapped up in looking at cash flows that I didn't build a diversified stock portfolio in the growth sectors of the economy. So you don't have to pick the winner. I mean, often people run around going, they're looking for the winner, the winner, the winner. You don't need to pick the winner. And in fact, you probably shouldn't try, but if you can figure out, and that's less difficult, what are growing economic sectors and who are the 2 or 3 top leading companies in those sectors, and invest in those and then let that sit. But make sure you do it across all kinds of sectors in the economy. So you didn't have to choose to invest specific. You might have invested in Cisco back in the late 90s for networking gear, and you'd be really disappointed because while they went up, they also came down really hard and they've never recovered that value. But you could have invested also in Google as part of the internet and Amazon and Microsoft, and now you'd be very happy with that total portfolio. Even if the Cisco was down, the others were up. And if you'd rebalanced along the way, you'd probably be even happier. So kind of looking at, I'd say some blockchain now would be great, but find the companies that are actively engaged in using blockchain or developing it out for multiple purposes, not just cyber currencies. To a large extent, my cynical view on cyber currencies are they're a solution in search of a problem. I don't think too many people were that upset about how the banking system was running or what was going on. We're using dollars to buy for stuff. I personally have never had an issue with that. I think the greater solution there is in the the massively distributed ledger database opportunities to improve sectors like real estate title or validating any asset that you have. I mean, that's a screaming need out there. So blockchain would be investing in various leading blockchain innovation companies, investing in various lead biotech and biopharma have mRNA opportunities are not just for COVID vaccines, they're for all kinds of other opportunities. So to the extent you can directly or indirectly hear from people about these exploding, rapidly growing sectors and get a couple of stocks in there, gee, I wish I'd done that.
Mm-hmm. Definitely. And also, bonds and gold are some types of investments that I personally wouldn't have considered right off the bat because that's just not something that I was like immediately drawn to. It's not as flashy as some of the opportunities. Like I've been looking into crypto a little bit. I find blockchain fascinating, as you were saying. When it comes to diversifying a portfolio, I believe that, and you were mentioning it earlier as well, that it's really, really important to look at stuff that you're not interested in as well. Do you think you could speak to that a little bit more?
Yeah, it comes back to the point I made briefly, like distinguish the difference between what you find kind of cool and fun and want to read a lot more about and learn a lot more about and maybe throw some money in, which I wouldn't even say it's a game, but it is speculative. Versus the portfolio that you're putting together to grow your wealth over the very long term or even the short term. It would be kind of, even as interested as you are in crypto, Emma, you would kind of tell me I'm an idiot if I said you should take the money you've set aside to buy a car in 2 years and put it in Bitcoin, because who knows what it's going to be worth in 2 years, but you want a car. I'm pretty sure you probably are not looking to roll the dice on whether you're going to be on a moped or a Rolls Royce, right? You kind of want to have fairly stable, fairly solid, probably very secure investment setting aside for that car, for that purpose. For your retirement, 50, 60 years down the road or whenever, you can afford to take a little more risk and blend it around, but you should have diversified assets in your portfolio. The best recommendation I can make for people who get drawn to a particular sector of interest is specifically ring fence a little portion of your investment portfolio just for that, right? So say, okay, I'm going to take 5% of my total long-term portfolio. I'm going to mess around in Bitcoin. And I'm just going to kind of make sure nothing else in the rest of my portfolio looks like that. Make the rest of the portfolio really boring, diversified in all kinds of things you don't care about. Like we said, a little chunk of gold maybe, or silver if you like it. Some large cap stock, some large cap international stock, some emerging market stuff, some debt stuff, some real asset stuff, some growth stocks, some value stocks, some biotech. In fact, it'll get more boring the more diversified it is because there'll be more things you aren't interested in, but that's okay. What you do is you look at it once a month and rebalance it, and then you go back to playing with your fun stuff.
Awesome. That's some great advice, and it definitely reinforces a common theme within our Making Sense podcast, diversification. So we have one last question for you, and it's a question we ask all of our podcast guests. But are there any resources you can recommend to learn more about the topics that we talked about today?
Sure, I'll recommend two different kinds. The first resource is me. I do have a lot of blogs that I've collected on this stuff. So if any of your listeners want to, they can feel free to email me. And I know you guys will give out my email, especially with a specific question, and I'll give them my best guidance that I can on where to go. For general resources for people who are interested in all this stuff, the three top sites. Seeking Alpha is a great site to go. They've got a lot of basic information. They certainly do a deep dive on all kinds of stocks and bonds and funds and securities that give you all of the quantitative data. But they also have a very large pool of people who write little articles and authors in there. Some of them want you to pay them for their higher end material, but most of them will definitely post high value added information and ideas that you can then track and follow. And by following a particular security, it'll pull up articles from authors writing about that security. Then you can assess whether you like that author's thought style and their writing style. Sometimes they're writing about investing in a way that doesn't resonate with you. Well, don't read anymore. Sometimes you'll find someone that, that's all they talk about is exactly how you're thinking about it. Then read some more. Though I always encourage you to read a little bit from people that you don't normally listen to make sure you're getting the other side of the coin. Investing.com is a great site too. They have a broader range of data available. They also have some people commenting on that. And there's actually a site called Abnormal Returns that collects, it's a blog. They update daily, but they collect information and blog postings from all across the web from a variety of different authors, a lot of it based around investing and investing concepts. And so I actually check that one daily to see if there's any interesting articles they've dug up.
Awesome. Well, thank you so much for joining us today, Anders. We really appreciated learning all about these tips when it comes to hedging investments and building a diversified portfolio through both bonds and gold. And then also how these different types of investments can relate when inflation changes with inflationary pressure. So personally, as I just began investing some of my money, I found these tips really, really helpful. So I hope some of these listeners also can agree with my sentiments here. And then one of my main takeaways was just how so many investors are focused on finding the next industry winner. It's really important to take a step back from that and think of industry leaders and other investments that can provide you with slow, steady growth over the years. So thank you so much for that.
Oh, well, you're very welcome. Thank you so much for inviting me to be on your fun podcast.
I'm glad you found it fun. And as per usual, I also wanted to thank everyone for tuning in today to today's episode. If you like what you heard, please consider subscribing to our YouTube channel and following us on Spotify, Apple Music, or wherever you stream your podcasts. And stay tuned to all things Red Thread Ventures by following our LinkedIn page and checking out our website at redthread.ventures. We can't wait to see you in their next episodes.